Most people think markets move because of news. A headline drops, prices react, something happens, and the chart follows. Clean, logical, cause and effect. Except that's not what actually happens. Because by the time you see the news, the move is already over. The shift already happened. The money already moved. The opportunity is already priced in. What you're watching is the echo. So the real question isn't why markets react. It's this. What moves them before anything happens? Right now, somewhere in the system, capital is repositioning. Quietly. No headlines, no alerts, no trending topics, just flows. Trillions of dollars shifting direction based on signals most people never see. And those shifts determine what happens next. Prices don't just respond to reality, they respond to expectations of reality. And expectations don't change loudly. They change early, subtly, almost invisibly. Let's start with something simple. Imagine two investors. Both are smart. Both are informed. Both are watching the same news. One reacts when the story breaks. The other acts before it becomes obvious. Same information, different timing, completely different results. Because markets don't reward who is right. They reward who is early. And being early doesn't mean guessing. It means watching the signals beneath the surface. Signals like liquidity, positioning, risk appetite, credit conditions, things that don't trend on social media, but quietly shape everything. Take liquidity, it sounds abstract, technical, easy to ignore, but liquidity is just the availability of money. How much capital is moving through the system, how easily it can move, and more importantly, where it's going. When liquidity is abundant, money looks for returns. It flows into assets, stocks, real estate, crypto, riskier bets. Prices rise, not necessarily because things are improving, but because money has somewhere to go. Now flip that. Liquidity tightens, money becomes harder to access, risk suddenly feels expensive, capital pulls back, and prices fall, sometimes before anything bad actually happens, because the condition changed first. The news comes later. Think back to major market moves. The crashes don't start with headlines. They start with subtle shifts. Credit spreads widening, borrowing getting tighter, funding costs creeping up, almost invisible, until they're not. By the time everyone notices, the move is already in motion. This is the first layer. Liquidity doesn't just influence markets, it leads them. And here's the part most people miss. Liquidity doesn't move randomly, it's influenced. By central banks, by policy decisions, by interest rates, by balance sheets expanding or contracting. When central banks inject liquidity, they're not just supporting the economy, they're changing the direction of capital. Lower interest rates make borrowing cheaper, which increases leverage, which increases demand for assets, which pushes prices higher, again, not always because of fundamentals, but because of flow. Now, raise rates, everything changes, borrowing becomes more expensive, leverage unwinds, demand slows, and the same assets that were rising start to struggle. Not because they suddenly became worse, but because the flow reversed. So when people say the market reacted to rate hikes, they're describing the surface. The deeper reality is simpler. The conditions changed, the direction of money changed, and prices followed. But liquidity is just one piece. There's another force, even more subtle. Positioning, where money is already placed, what investors are already holding, and more importantly, what they're not. Because markets don't just move based on new information, they move based on how surprising that information is relative to expectations. If everyone expects good news, and it happens, nothing changes. The move already happened earlier. But if expectations are wrong, that's when things get interesting. Imagine a crowded trade. Everyone is on the same side, long the same assets, short the same risks. It feels safe. Consensus feels comfortable until it doesn't. Because when something shifts, even slightly, everyone tries to adjust at the same time. And that's when small changes become large moves. Not because of the news itself, but because of positioning. A market that is heavily positioned in one direction is fragile. It doesn't take much to move it. Just a small imbalance, a shift in confidence, a crack in the story. And suddenly, exits get crowded. Prices move fast, sometimes violently. This is why markets can rally on bad news, or fall on good news. It's not irrational. It's structural. It's about who is already in and who still needs to act. Now, layer in another element. Time. Markets don't operate in the present. They operate in the future. Prices today reflect expectations about tomorrow. Earnings that haven't happened yet. Growth that hasn't materialized yet. Risks that haven't fully appeared yet. So when something changes, it's not the current reality that matters, it's the expected path. If the future looks better than expected, prices rise. If it looks worse, they fall. Even if the present looks fine, this is why markets can feel disconnected, because they're not measuring what is, they're pricing what could be, and that makes everything more sensitive, more reactive, more anticipatory. Now combine these layers, liquidity, positioning, expectations, you start to see the system. A system where prices move not just because of events, but because of invisible forces adjusting beneath them. And those forces don't wait for confirmation. They move early. They test levels. They probe for weakness. They respond to signals most people never notice, like changes in bond yields, shifts in currency strength, movements in credit markets. These aren't side stories. They're the foundation. Equity markets often follow what's happening underneath, but most people don't watch those layers. They watch the headlines, which means they're always reacting, never anticipating. Now here's where it gets uncomfortable, because if markets are driven by these invisible forces, then most explanations you hear are incomplete. The market went up because earnings were strong? Maybe. Or maybe liquidity improved weeks earlier. Positioning was light, and expectations were too low. So when earnings came in, the move was already prepared. The story just caught up. This doesn't mean fundamentals don't matter. They do, over time. But timing matters more in the short term. And timing is driven by flow, not just facts. Now, let's talk about speed. Because the system isn't just invisible, it's fast, extremely fast. Algorithms, high-frequency trading, automated strategies reacting in milliseconds. But even that isn't the full story. Because the real speed isn't just execution, it's information. Who sees changes first? Who interprets them correctly? Who acts before consensus forms? And increasingly, that's not humans. It's systems, models, strategies trained to detect patterns across markets. Interest rates, commodities, currencies, all connected, all feeding into each other. So when one part shifts, others respond instantly. And by the time it reaches the average investor, it's already been processed, priced, absorbed, which creates a strange dynamic. The more information becomes available, the harder it is to act on it, because everyone has access, but not everyone has speed, or context, or positioning. So the edge isn't just knowing something, it's understanding how it fits into the system. Now zoom out, because this isn't just about trading, it's about how the modern financial system operates. Capital doesn't sit still, it flows across borders, across asset classes, across risk levels, always searching for yield, for safety, for opportunity. And those flows create cycles, periods of expansion, followed by contraction, risk on, risk off, boom, slowdown. Not random, but driven by changes in conditions. Liquidity expands, risk increases, assets rise, then something shifts, liquidity tightens, risk decreases, assets fall, and the cycle continues. But here's the part that matters. These shifts don't announce themselves, they don't come with warnings. They appear as small changes, at the edges, in places most people ignore, until they're too large to ignore, and by then, the move is already happening. So what does this mean for you? It means the visible story is rarely the full story. It means markets are less about reacting to events and more about understanding conditions. It means the biggest moves often start quietly, without confirmation, without certainty, without consensus. And that's uncomfortable because it removes the illusion of clarity. There's no single signal, no perfect indicator, just a system, complex, interconnected, always adjusting, and always moving slightly ahead of what's obvious. So the next time you see a headline explaining a market move, pause for a second. Ask a different question. What changed before this? What shifted underneath? Because that's where the real story begins. And once you start seeing it, you can't unsee it, because the market isn't reacting, it's anticipating, and the invisible force moving it is already at work, right now, before the next move, before the next headline, before anyone explains what just happened. And that leaves you with a final question. If markets are always moving ahead of reality, how do you navigate a system where the most important signals are the ones you don't see?